Well, good afternoon all. Thanks for joining us today for today's webinar. I'm Stuart Lohman from Biz News. Our guests today are Martin Freeman and Justin Clarke, both from Accretive. Gents, thanks very much for joining us today. Just before we get into it, I know we've got lots to talk about. I just want to do a quick tech check. For those new to the webinar, there's a little raise button on your control panel at the bottom there. If you can see all three of us on screen and hear my voice coming through, can you click that raise and give us a high five, as they say? Just to make sure it's, there we go. That's looking good. Thank you very much for that.
We'll do it as well, just in case you don't see us here.
No, thanks for just. Also on that same button, control panel, apologies, there's a little questions option. Can you please put your questions in there? I'll pass them on to Martin and Justin as we run through, but we've got a little presentation and some interesting points to get through. But Martin, quickly from your side, I know you're based in the US. You are the CEO of Accretive. How is sentiment on the ground?
So it's a great question and an interesting time to answer that because, it certainly has gone through its ups and downs in the last literally 90 days. I think that the US economy was, again, demonstrating its absolute resilience, unemployment's of low numbers, very strong economy, and really people feeling very confident. And then all of a sudden we had the start of the war. That in turn has pushed gas prices up dramatically, which is impacting people and affordability. And given the fact that there's midterms essentially in the next couple of months, I think that everyone is starting to jockey for position to make sure that they appeal to voters. But I think from an overall perspective, I think the US remained very strong. There is obviously tremendous excitement and a lot of spending and investment that's going into data centers and AR. But at the same time, I think there remains concern about the evolution of AR. And so what all this means is at least we can also then finally put a tick next to the name of Kevin Wolf as Fed chairman. And that is a sigh of relief, I think, for anybody, especially those in real estate.
So he's going to be sorting on Friday, isn't it? Into the Fed. So that's interesting. Just quickly, I'm hearing a lot of podcasts with the energy sort of question and the AR data centers. I know it's the smaller towns that there's a lot more concern around with electricity prices on the up due to this infrastructure push.
So I think that the amount being spent on infrastructure and data centers is just astronomical. It really is very, very large spend over many years and decades ahead. But as we know, it is the future of where we're all moving to. I think that there is a clear plan and a clear execution. And whenever I speak to anyone at the moment right now, the buzzword is the data centers and literally trillions that will be spent on it.
Excellent. Thanks, Martin. And Justin, I know you head up the operations side. I know Chief Operation Officer, if I'm correct. I know it's operations head, but I know you are based in Durban, but you recently made a trip to the US. How was your perception of what's happening there?
Yeah, no, that's super interesting. I think that everyone's perception is that the US is very aware of the war. They aren't. No one seems to know there's a war going on, except what they do know is the price of gas at the pump. So gas at the pump, inflation, I think, is a concern on the average American's kind of lips at the moment. And that is super interesting. As Martin said, very, very buoyant economy. It's just incredible how that machine just continues to pump. And Stuart, I mean, I was over there for a couple of weeks, spending time at some of our buildings where we've got vacancy. And I think that on the old medical side, I think a lot of our old investors would be interested to know. We have some suites that have been vacant for a while, and we're looking at these and thinking, why is it that we have a vacant suite in an area like Phoenix or in Florida where, we shouldn't have a problem leasing a medical building? And I think that our current strategy is that we're going to throw some money at building these spec suites out. In other words, you build it perfectly so that when the doctor comes in, most of the time it's not the doctor going and it's a nurse or a wife, and they're a bit more emotive about the place. It's got to smell nice and look nice. Otherwise, there's no ways you can sell them from not even a white box, the old premises that was left there from the last doctor 10 years ago, So I think, we're pretty excited about that for occupancy. And so we've initiated a couple of sort of spec builds in these buildings that we've got sort of sticky vacancy.
That always, you remind me when you sell a house, Justin, I always say, make sure you bake in the morning so that the smell is there for the people who come visit in the afternoon, because it creates that homely effect. And I suppose it's the same with all these house hunter shows and how houses are staged so that you are people's vision for a unit. So very interesting.
Exactly. No, exactly. And it's the
Well,
same.
I know
I mean, maybe in other types of commercial, office space, there's no emotive play at all. But certainly in medical, I think that's where, it's very much the doctor's home for his next 5 to 10 years. He looks at it differently to, a corporate renting an office.
Excellent. Just quickly, Martin, all these short-term fundamentals that change sort of on the short term, but long term, maybe not so much. Does it change anything with what you do at all, Accretive?
Well, I think that the first thing is from an acquisition perspective and a disposition perspective, it absolutely does, because your timing around it is based on interest rates and pricing. And as we know, everything moves in real estate with the interest rates. And so when interest rates come down, everything is valued higher. Debt is easier, the banks loosen up. And conversely, when it goes the other way. So, the frustration at the moment right now, as you can see by the treasury rates, that because of the war and concerns about inflation, it bounces up almost artificially. And it bounced literally 2 weeks after the war started. But at the same time, the bank's front run changes. And so there is sentiment that the moment it starts to be perceived that the war would be over or is going to come to an end, we believe it'll drop quite dramatically. The interesting thing as we talk about the Fed chairman is because, as you know, the president of the US is determined to drive rates lower. Because he believes that that is one of the catalysts for real estate and home prices also, and affordability. And so that's one of the key drivers going forward, which obviously affects anyone in real estate.
Excellent. Thanks, Martin. I know we're here to talk about Alabama and GexPro. So let me just bring up that presentation, Justin, and we can get started. There we go. Cool. You want to take it away? I'll push the slides and just talk through. Yeah, cool.
Thanks, George. Yeah, so I think the last time we spoke, we had launched this Accretive hybrid fund. And effectively what it is we looked at the whole market. We decided that healthcare, while we really love healthcare, it is unfortunately very close to office, and office has got a big vacancy problem. And so we notice of that at the moment. We looked at industrial. We were fascinated at this, what they call small bay or shadow bay industrial. And it's really just factories that are smaller than 50,000 square foot, going right down to your mini factory that you would see in your average neighborhood. And generally, these sort of tenants are the sort of people that are not going to get impacted by whatever AI. It's the plumber, it's the builder supply, it's those type of smaller industries that are very, very safe because nothing's going to disrupt them. So we like that. When you get to the other side of it, the slightly bigger spaces where we're going to talk about today, you get heavy industry. And remember us talking about medical and about imaging, X-ray equipment. Once the X-ray equipment's installed, you're never going to move that X-ray equipment out. And it's the same with a heavy industrial factory. Once they're in, they stuck there. And so we obviously started to double click on this small bay side of the industrial space. And you can see from this that it's quite amazing. This graph shows vacancies since 2010 right up to 2025. And you see office going absolutely pear-shaped there. That's the purple line. And then at the bottom, the other extreme, you've got small bay industrial. And you can see since literally 2020, just after 2010, it has been the best performing in terms of vacancy. And remember that the big thing with real estate is vacancy. If you've got your debt organized and you've got your tenant organized, everything is 100% safe. If you have no tenant and debt, you have a problem. This shows the overall vacancy. And I think, again, you can see that vacancy has really, really dropped off. The black line is shadow bay, and the blue greenish line is the general market. So once again, shadow bay is sitting at around about 4% vacancy now. That's not really vacancy. In fact, the banks, when they loan money on a fully occupied building, they say it's 95% occupied anyway. So they would assume there's 5% vacancy in any event. So that's pretty remarkable. And it's actually tracking in the right direction if you were taken into 2026 for reasons, other fundamental reasons. And if you look at the next slide, you'll see that once again, if you were to assume that 100 is zero in 2010, and rental increases as a result of this shortfall in supply have gone up 50%. So your rental increases over a decade have gone up by 50%, which is quite substantial. So all of the fundamentals are really, really strong for this particular sector, which is why we have doubled down on it and we're doing this little fund. So what is this little fund, Stu?
Justin, if I can just jump in here also, I just wanted to, make the following comments again. Remember, one of the things also driving the tailwinds is the fact that there is this massive push for onshoring in the US and job creation and manufacturing at home. And then on top of that, you've also got the issues with the tariffs globally. And so what this means is that if you factor all of that in, and the fact that the cost of new construction is just so expensive in the US that, the rentals you would have to charge would be so significantly higher that everybody just continues to flock to the existing buildings, which means that the vacancy just keeps moving in the very strong downward direction as a trend over time.
Absolutely. And we can even add to that, I think, Mark. If you look at 2020 on the graph there, what did everyone do? They were locked up at home and they immediately went online and started buying things like crazy in the States. And every single online vendor went ballistic. They had to have more logistics space. They had to try and get product to the customers who were sitting at home locked up. And there was this absolute rabid demand for industrial space, both small and the big boxes. And what happened is rates was super low, inflation was super low, and the developers got into the market like crazy, Stuart, and they built a complete oversupply in the top end of the market. Bottom end of the market, they didn't bother with because it's not ready for the big developers. It's the small stuff. It's the small bay stuff. So they didn't get into that space substantially. There wasn't a lot of supply in the small bay space. But I think the interesting thing is then what happened? Inflation kicked in, rates cranked up, everyone stopped building. And of course, you've had this oversupply in the big bay, and that's now getting absorbed. And in the small bay, there was never an oversupply, and it's just continuing consistently to be absorbed. So yeah, it's really a really exciting space.
Justin, you mentioned sorry, Martin, shallow bay rents, is that obviously the location where you're looking at, hey?
Yeah, shallow bay just means it's really a small factory. Shallow normally means that the factory is not deep. You're loading a bay and the back wall is shallow. It's nothing very sophisticated. Yeah. No, they generally in infill triangles, the sort of mini factory that you find in your neighborhood, that kind of thing, out to the bigger, the 50,000 square foot, more industrialized factory just on the outskirts of your city.
So Martin, go.
I was just going to say also one other thing that has changed in the US, and I think it's a trend around the world, which is the instant gratification of online shoppers. So, if we think back 2-3 years ago, you ordered something online and you were quite comfortable if it arrived in 7 or 10 days. And that has changed dramatically, especially in the US with Amazon. I mean, literally, you can order something and it's at your door tomorrow. And, with that, what people are starting to do is they're starting to hold more inventory, and they're starting to move from where they had stuff in their house to almost bringing in a 20-foot container and taking up space in industrial warehouses. So that has also soaked up a lot of the area, because what's happening now is people just have to have the stock available, as you just can't do the sales.
I was going to say they've probably been burnt by Temu orders, Martin, so that's also helped the Amazon business model. But anyway, that's for another discussion. Justin, you want me to move to the next slide?
Yeah. So I think let's get on to what we're trying to do. Some of the things we've learned in the past is this is a portfolio of buildings that we want to put together. Why? Because there's always a chance that you have a problem with one building, and you don't want to be an investor in one building that has a problem. So by lumping them together, you get a lovely diversified risk spread and a much more consistent return that you can sleep well at night knowing it's going to come in. And I think this is really why we kind of don't like doing the single buildings anymore. And so this is just the 2026 industrial portfolio. We are set on acquiring 8 buildings during the course of the year. We are running a little behind, but I think we can catch up. And we are on building number 3. What slowed us down is building number 2. Perhaps you want to talk about that lovely building in Allendale, Mart. And I think this gives you, a great reason, Stuart, to understand how careful we are during the acquisition progress. And we were weeks away from closing. And Martin, you can talk about while that building number 2 was paused.
Thanks, Justin. I think one of the things is that, we really are very particular now with our final agreements in terms of we know what we want out of every single deal. We know what our expectations of the tenant. And in that particular deal, while it's also a potentially 15-year lease, one of the dominant players that acquired the second biggest player in the state, ultimately it came down to we are insisting at this stage on certain securities. We're insisting on certain agreements, whether they can do certain things in the lease regarding renewal rates, etc. And, that's the reason why it's been paused, because until the existing seller, who is the tenant, agrees to it, we just simply won't go down that road. We'll rather find other deals if needed. There's lots of opportunities we've seen come across our desk, and we feel very comfortable with our progress on this portfolio and the returns to investors.
So just obviously to try and fulfill the 8 this year, or is there leeway to move in and wait for the right opportunities? Or you're on a sort of strict deadline?
No. I think that raising the equity, we're pretty much locked into this year. But to the actual acquisition, we can do after the end of the year. So we don't have to get 8 done this year. We can actually roll over into year 2. Obviously, we want to get it done as soon as possible because we want to try and stretch that IRR as much as we can.
Brilliant. So should we get into GexPro, Theodore? Next slide.
Yeah. So this is actually what you go out and you look in the market for. And I think I said it's like kissing frogs. Thank goodness I don't have to do it. It's not my job. But you look through lots of buildings. You go through lots of disappointments. You go through lots of negotiations, and then suddenly you come across something like this. So what is this? This is in Alabama. And initially I thought, well, Theodore, Alabama, I never heard of it before. Well, obviously I've heard of it, but my perception of Alabama is not great. I wouldn't think of it as an industrial hub. But it's actually quite remarkable, this industrial area of Theodore. First of all, it's right on the port of Mobile. And Mobile is probably going to be the biggest port on the Gulf of America / Mexico, whatever you want to call it. And it is growing like the clappers. Who is there? Well, there's Austral shipbuilders. There is companies like Airbus. They manufacture all the North American aircraft there. And what does GexPro do? GexPro manufactures components for all of those individual industries. They are in multiple countries. They have multiple manufacturing hubs all over the US. And we managed to acquire this one with nearly a 9-year lease. And so 2 things when you're buying an industrial building. Number 1, is it likely that if something happens to the tenant, you can get another tenant? Is it in a good area, etc.? Number 2, is the tenant going to continue to honor the lease for the full period of the lease? And I think that we are very comfortable that this is not a tenant going anywhere. And we're very comfortable that we've got nice long lease term and buildings that are in the right area. So those are the key things. I think that other remarkable thing, Stuart, is that we are looking at buildings in the medical space. We're looking at acquisitions of the 7.5s. We bought this at 8.21% cap rate, and this basically means that we bought it for a super cheap price. We're raising 2.7 million in equity, and we paid 8.2 million for the deal. Let's have a look at it in a bit more detail. As I mentioned, this is a graph. You can't really see a lot from the graph there, but to the left, in the left-hand corner of the picture is the Port of Mobile. As I say, dramatically fast-growing port. They say it will second fastest-growing port at the moment in the US, but I think that might have changed because in some stats it's showing as the fastest-growing port. It's super close to, as I say, to the port and to the industrial area. Theodore is a growth hub for various reasons. So we all know the reason why things grow is because there's incentives. It's a tax-friendly environment. Property taxes, which are sort of important to us, although this is a triple net lease, that means that the tenant covers all of the things like property taxes, complete triple net lease. So I think we're probably enough on the area. It's also about 30 minutes from the airport. So it's really nicely located. Let's look at the next slide. As I said, the most important thing is the tenant. And I think looking at building number 2, as Martin said, we had some concerns about the tenant, and ultimately we're relying on the tenant signing a 15-year lease. In this case, we've got 9 years of lease left, and this is the business that runs there. All their customers are blue chip. As I say, they make renewable turbines for the renewable industry. Long order book. They supply Airbus, and as I say, multiple other significant OEMs that manufacture major brands that we all know about.
Justin, just to jump in there, just a couple of pieces of the puzzle, because I was actually intimately involved in this. Number one, how did we get it at such an amazing price? Well, the seller actually had put it on the market. A 1031 buyer came in, which is somebody who sold their building and was transferring their money straight into another asset so that they could defer their tax. They messed them around for a long period of time and eventually found another deal and went in a different direction. So they were so particular about who is the buyer this time around. Will we fulfill? Will we honor our obligation? What's our reputation like? And so that's the reason why they were comfortable to do it with us and enter into this deal. And they just wanted certainty of close. The second thing also, let's not forget that the tenant, GexPro, is actually part of a subsidiary of a listed company on the NASDAQ that has multiple very large investments. And I think they're over $1 billion. So very, very big setup this. And so we're delighted with this building as you move further into the discussions about it.
Yeah, absolutely. They are part of the DSG group, which is 1.3 billion in annual revenue. So yeah, so super strong tenant, as we mentioned. I think coming back to what's in the building, they have 6 cranes that work on very large pieces of equipment, and those cranes are 25 to 30 tons. Now, to move those cranes, it would just not be viable. So these guys are built up in this factory. I think they moved in 2021, and the stuff that they put in here, they wouldn't take out. If they close this division, that would be the only reason why they would close it. But as you can see, they've invested $2 million in new equipment over the last year since they signed the lease. And one of the closing conditions that we've agreed with them is that they will reconcrete the entire outside driveway area that they've done some damage to with their heavy loading, heavy forklifts, etc. So I think you can see from the picture, it's some fairly substantial stuff going on there.
Cool.
And
next slide, Justin.
Then it's just the financials. As I say, if you look at the bottom, you'll see that we are allowing $1 million of our institutional VIP investors from the US to participate directly at the property level. We didn't do that on the last building, and our contribution will be 1.7 odd million to make up a purchase price of 8.2 million. We are basically we have a hurdle rate of 7%. That means we pay out 7% on an ongoing basis through the project. And I think that, as you can see, the building can do it quite comfortably. We haven't talked at all about the debt here, Martin, but we have secured the debt at just over 6%. So the delta always is that you need to look at the difference between what you're paying in debt and what you actually what you bought the building for. So buying at 8.2 with debt of just over 6, you've got a nice spread to make sure that you can generate consistent returns. That's really it. And then, of course, the final page is just how we intend to distribute the returns. 3.5 per quarter, per year, will be distributed to the investors. As I say, the investors will be 2 different investors. One will be the institutional investors sitting in the US, and the other will be the fund. So that's really the story of GexPro. And as I mentioned earlier on, the best way to get involved in buildings like this is to invest in our little 8-project portfolio, and we've made that super easy through the Seychelles vehicle that we have done previously. So, Stu, that's really the story.
Excellent. Thanks, both. Justin, just quickly, you mentioned it's available through the hybrid fund on the platform. What's the minimum investment for an individual?
It's $5,000.
Okay, cool. Perfect. Just some questions quickly from Paul. It's actually referring maybe not to the medical thing, but he's wondering, is this a shift, the medical portfolio now being targeted to be actually wound up and sold off as close to possible? And what is the projected time frame for this process? I'm not sure if that's even in the thinking, but that's how he's seen it. Is it not a shift in focus?
Let me go first, March. So basically how these things work, just to make everyone understand, that when we were doing the single buildings, it was 5 years, you buy in the building, at the end of 5-year period, we sell the building, there's a capital growth, and of course that profit is shared with the investor, and that's how you get your return. And with the funds, it's exactly the same. So the medical fund, we stopped taking money in, a year ago now, I think, beginning of 2025, if I remember correctly. And that is closed. And now we look for the opportunity of A, adding value, and B, the right opportunity in the market. Because remember, you don't want to sell it after all this and time and effort that everyone's put into building this portfolio. You don't want to give it away for free just because there's a war on. So we have, Martin has spent an enormous amount of time, investigating basically 3 options. The first one was an outright sale. Timing is just not right at the moment, and he can elaborate a bit on that. The other thing, as I mentioned, is to look at the vacancies and to fill those vacancies. If we can fill vacancies, we add an enormous amount of value. So we have the balance of the 5 years, which is about 2 years to run, and in that 2 years, we're going to do the best we can to sell that portfolio. This Accretive hybrid is exactly the same. And hopefully we're on the right side of the curve. Bear in mind, when we were buying medical, we were buying at interest rates of 3% with a cap rate of 7%. Now we're buying at interest rates of 6% with a cap rate of 8%. So we're on the right side of the curve. Hopefully it will all reprice down back to where it was before, and we'll be in the money. So that's the story. But Mark, you could perhaps speak more eloquently about that.
No, I think you summed it up well, Justin. I think at the end of the day, markets are fluid. You move to where the puck is, as they say in the US. And I think that, medical still holds a tremendous amount of potential. But we see a lot of opportunity and a lot of real good, solid investments in industrial. And we love the niche. And I think that also, just from understanding industrial, it's the same across the entire world. The fundamentals are very similar, and it remains a very buoyant part of the US economy going forward. We certainly believe that it's set for a nice trajectory ahead.
Thanks, Martin. Costas just wants to ask, do retailers earn 7% per annum? I think you touched on that, Justin, but just a clarification.
Yeah, to retail investors. In other words, you invest to earn 7% per annum. Correct, yeah, individuals.
Well, bearing in mind, I just want to also clarify, there are 2 components to investing in real estate. One is what you earn per year, and then one is the capital gain. Those 2 together is your total IRR, internal rate of return, which then gets you to double digits.
I was going to say, isn't that the biggest challenge in any investment, though, is the exit? It's all, the dividends are a great thing, but it's the exit at the end of it that's a bit of a challenge sometimes.
And that's the reason why we always like to, talk about cash on cash and cash flow, because that is something that is reasonably consistent. And hence the reason why in a lot of our transactions, we are focused on cash on cash as opposed to only IRR. So people will go into other asset classes, which is called value add. There is no cash. You are only reliant on the exit. And, sometimes also that plays into timing and global sentiment and what's happening in the world.
Great. Pete just as a follow-up, he says, could you just clarify for investors, are you still expected to achieve the original 7% annual return and 11% uplift at maturity, and whether you expect to have sufficient liquidity to fully repay in capital at maturity in 2027? That's on the cash flows I think you touched on, Martin.
So look, at this stage right now, as far as our portfolios are concerned, we see upside in the portfolios. Justin's doing a great job in terms of, what he's supposed to achieve in terms of leasing, in terms of renewals. And as far as we are seeing at this stage right now, we are seeing the potential of a decrease in interest rates, which will lead to a decrease in cap rates in the coming year and more going forward. Certainly, if you look at the long-term trend of the 10-year treasury, it does bode well for real estate in the future.
Justin, anything to add?
Yeah, I was just the 11% was just had me a bit confused there, because we did have a small pref when we launched this. I don't think there's any pref left, and that was an 11% pref for the first early investors who put money into the fund. So those are effectively getting 11% at exit, and but that pref, as I say, we don't have that available anymore. And I think on this portfolio, it's we're not looking at anything extraordinary to shoot the lights out. And Mart, you explain it so well when you talk about your annual escalation that's in every single lease. If you've got a very simple 10-year lease, or as we have on this one, 9-year lease, and it escalates every year, 2 years, you can work out what your capital gain will be at the end of the 5-year period. And provided that your cap rate just stays the same, in other words, you sell the building at the same cheap price you bought it for, you made a 30% capital growth. So I think that's pretty much why you can sustain the kind of the sort of returns that we think are very achievable on this industrial portfolio.
And I just want to jump in there. It was very interesting, when we started on this journey many, many years ago, escalations were sitting at some deals, and there was no escalation. It was just, you got a small nominal bounce every 5 years. And the traditional escalation was 2%. And then over time, it moved to 2.25. And then COVID hit, and it went to 2.5 and then 3. The good thing in industrial is you're able to sometimes push with slightly higher escalations, because you're not dealing with a major medical company in the US that's got, hundreds of billions, and they're pushing you around. So it's a little bit more flexible than industrial, and that gives you your real growth in your net operating income, which gives you your growth in your exit value when you do exit. And that's what we also like about it. We will also, as part of the portfolio, be looking for deals where potentially, there's other ways to increase your net operating income, which is where, for example, you've got gross leases, you convert them to net. Your rental rates are below market. Because remember, a lot of these buildings are the very reason we got into medical in the early days, Stuart, which was the fact that you're buying from an unsophisticated seller, or you're buying from the guy who owns the building and has had it for 10, 15, 20 years. The problem is on the medical buildings, it's always now the big guys against the big guys, or larger players like ourselves against the larger players. Whereas in industrial, very often you're finding it's just a normal guy who's just owned the building and he's just retiring now and he wants out.
Yeah, I suppose I'm just reflecting on what Peter was saying. It's almost like he's concerned maybe that when the investment comes in, the liquidity has to come through the sale of the buildings, because the cash can't obviously cover the payout, as an example. I don't know if that sums it up properly. I'm just trying to simplify what he's trying to say,
Correct. And there's two things which happens. Number one, your income goes up, which means you should get more for the building, even if you had the same formula when you bought it and you sold it, assuming no compressions. Okay. The other scenario is that, you have interest rates move down, which means your cap rates move down, which means if like for like you bought a building for 7, then you should get 8, because the fundamentals are different. Think about it from a house perspective in South Africa or around the world. If your interest rate dropped dramatically with, the rate overall in the coming year or 2 or 3, the value of your house goes up because people can afford to pay and take a bigger mortgage.
Brilliant. Justin, anything to add there?
Yeah, no, I think he covered it well.
Do you guys see any sort of, I know we touched on the short-term challenges, but do you see anything on the horizon that could sort of not be as something that derails a bit? Because I know you've got 2 buildings at the moment in the fund. If there's nothing else, you just carry on as is for the rest of the year, or do you have to find sort of assets?
Oh, there's plenty more. There's plenty more. I think there's a lot of stuff. In fact, there's a medical building that I think Martin's looking at today. But yeah, we just got to find the right thing. As I say, we're not buying at the wrong price. You'll see we absolutely stuck on the 8% and what. We might go a little bit below that if there's some other way of bouncing the return. But maybe just going back to, yeah, sometimes we overcomplicate it. Basically, we've got a tenant that pays us rent. The cash that we get in from the rent, we use to pay the debt, the bond, and then we have a surplus. If it's a triple net, it means that we don't have any other responsibility. We don't have to pay for the broken HVAC or the whatever, waterproofing, whatever. That's all the responsibility of the person who occupies the building. So all we have is that very clear cash flow. And then we take that clear cash flow and we pay it out. And that's the 7%. And it's a little bit over that. Obviously, if you look at the pro forma, if Pete wants to look at the pro forma, we can go through it. But it's actually, they generate more than 7%, but we keep a little bit just to make sure that we can always make the 7% in case the rent check comes late or something like that. But this type of building like GexPro, you get your money exactly on the same day every single month. There's no issue. With medical, it's a bit more complicated. You've got 8 tenants, some of them pay legs on them. It's a lot more management in a medical building.
Brilliant.
I would say, Stuart, in terms of maybe if we talk about risks, the risks going forward around disruption in certain areas with AI, and we need to be open to those kind of changes. Hence the reason why every single tenant we're looking at now is your business more resilient or not? This kind of tenant over here, they've got massive, massive teams that when these enormous machines that come from around the world, built by these very large players like General Electric, etc., something goes wrong. They need a team of these guys from GexPro to go in and basically fix it immediately because it just costs them millions to have it sitting idle. And so these are the kind of businesses we're looking at. And so I would say that AR certainly in a lot of sectors is a potential curveball. Hence, our tenant assessment is critical. And then the other thing also is the fact that we have a little bit of a strain going forward on interest rates and inflation in the US because of circumstances on the war. But then the good news is that a lot of our leases are triple net, which means we don't absorb the inflation, whatever it is the tenant's paying anyway.
Yeah, I see. Our local inflation also got a bit of a kick today with that petrol price. I think you mentioned risk there, Martin. I think that's the key element here because I've got people saying, is there an assurance? But you can never really give 100% assurance on a maturity. I mean, it's an investment in its nature, but that is the plan of the investment is to have that available at the end of the 5-year plan or 4-year plan, etc. But I think it's difficult for me. Yeah. Eh?
Yeah. So, I mean, the answer to that is that, we used to do primarily individual buildings. And the reason why we moved to a fund is because what we found is for most investors, they wanted to sleep well knowing there's diversification, not only across buildings, but across tenants and across states in the US, and that I think has really helped with a lot of our investment thesis. And I think also, when it comes to risk, I think you also want to make sure that if you follow that strategy, you are investing in bricks and mortar. And therefore, as opposed to investing in the stock market or in a tech company, which literally can go from where it is to 50, 100% potentially downward direction, at least here, there's always that underpin of real estate is real estate.
I was going to say, is that not also something for the future? We don't have to get into your plans, but you move it into sort of an exchange option so that it is more in and out liquidity for investors. I'm not talking about for the investment in the buildings themselves.
Well, yeah, very interesting. And maybe we'll be having another webinar in the short future.
Yeah, I think Stuart, that that's what everybody's concern is liquidity. You put your money in good faith, and then you suddenly get to year 3 and you decide you need your money out, and you can't sell at a loss like you would at the the JC if you choose to get out at the wrong time. There's no liquidity. No one's gonna buy you out at a premium. So the intention when we went to the Seychelles exchange was that there would be liquidity and there would be certain amount of trade and the ability to trade shares and not. Actually, that's never really happened. But as a side note, there's some stuff going on that exchange, and I hope that'll improve. But I think to Martin's point, there's a bigger picture that we're looking at the moment. You really need to get out of these little islands. which
Yeah.
might be convenient, but they're just there's just no liquidity there.
I don't think it's just the island exchanges. I mean, my days at CNBC Africa, a lot of the African exchanges, the liquidity was the biggest issue. It's always been. That's why you go to US market as an example, but that's for another discussion, I think. Just trying to appease some of the fears on that side. But just with regards to you've got two of the potential 8, Justin. Can you give us any idea on where you're looking, or is it just it's open book at the moment for future acquisitions?
Oh, there's
Martin
a few
as well. So
Martin, you've got a few that are being underwritten at the moment. So I don't know if you want to pick up any one of them particularly.
Absolutely. So we've got some really great deals we're looking at the moment right now. Clearly, we have put in quite an aggressive offer in terms of the letters of intent, LOIs. We are waiting feedback, and I think that we should have the next 1 or 2 under our belt within literally the next 45 to 60 days. I'm very excited about that. And again, great prices, good fundamentals, strong tenants. If it doesn't tick all those boxes, I'm not even looking at it.
It's a good place to be, I believe, if you've got that in negotiation. Justin, I think I'm finished on the question side on the webinar platform. Is there anything else you want to add, end off with?
Stuart, no, I think we obviously did well if there's no questions, which is great. But if anyone wants to get hold of us, you know how to do that. You can get hold of myself, you can get hold of anybody in our team just by firing a mail to info or support@allbest.com. And then you'll speak to anyone in the South African team who can help you with any information. We've got a little flyer on this particular building if you're interested in the building particularly, and we've got a brochure on the fund itself. So if you want that, reach out to us and we'll be happy to help.
I've also put the link on the platform as well, the chat there. Martin, anything final from your side?
No, thank you very much for having us today online, and we so appreciate the relationship with you guys. Thank you.
No, excellent. Thanks for your time both, and thanks to everyone for joining us and giving up their afternoon. The team will put the webinar on the YouTube channel later this afternoon, but thank you very much and have a good day. Ciao.
Thanks, Stuart.